Mm-hmm. American institution. Everybody up to speed on the Elon Grimes situation? Doesn't sound good, man. I'm a little concerned. Hope everybody's going to be okay. The lighting's weird. I don't get it. What is this thing doing? I think it's YouTube. I think it like dims the top of the frame, so I can't. I don't know. It's hard to get a good like. I guess people get like wide format webcams. Like the MacBook webcam is it's super weird. This is so tight. I don't want to break it because it's actually vintage. It's super slick, right? I think this is from like 82 or 83. Dig today's fit. I also brought out the big dog. That's the bullhead. That monster sits up. But yeah, that's a Seiko bullhead. It's part of this whole, there's like 5 of these movements. They call it the bullhead because all the punches in the dial are at the top. So it looks like 2 bull horns. But yeah, this is the same one that the, whatchamacallit, the Pepsi with the gold face, and then the Panda, the UFO, and I forget. I totally shut off all the watch stuff. That was like a fun thing I did over the summer. I stopped paying attention to it. Excuse me. Yeah, it's this particular movement, and they made 5 of them. It's the 6138. That's right. So the Seiko 6138. There's the UFO, the one that one of the Russian cosmonauts wore into space. And then this bullhead. There's 5 of them. There's a good article on 60 Clicks that covers them all. But the one I really want, I never got it because they just go for stupid money. Is the what's it called? The Kakume, the Kume. The Kakume. It's blue. It's like a panda with square dials and an orange chronograph tracker. It's so good, but some of them are like not worth it. Like the UFO is so ridiculous. Like it's so massive and over-engineered. I can't stand that. And then the other one, Jumbo. The Jumbo is so crazy. Like the face is, it's like wider than your wrist. It's just silly. So the Panda's okay. I think it's kind of nondescript. But yeah, if you look at the 6138 and 6139 Seikos, this is the bullhead. And then there's a bunch of other ones. I think the one I'm thinking of, the Pepsi one, is actually, I forget that movement. But the 6138 has some really cool examples. The UFOs and the calculator are absurd. But the Panda, the Kakume, and this are nice. Yeah, so that's why I brought out that one. But the reason I brought it out is I wanted to talk about, somebody mentioned like a little curiosity about what, like how I know about finance or what I think about it. Or, I worked for, big, huge multinational financial corporations my whole career, up until recently when I made the shift to just doing pure technology as my career. Like you may have heard of, during the crisis in 2008 when Lehman Brothers collapsed, there was a thing called TARP, the Troubled Asset Relief Program. And I was actually in the room when they developed it. Like it was literally just the heads of Bank New York Mellon, Fidelity, State Street, Ned, Mr. Johnson, The guy named Roy O'Hanley, or Ron O'Hanley, I can't remember. He ran BNY and then he went over to Fidelity. Just like the biggest people in finance. It was crazy. And I was there because I did their BlackBerries. And like, it was just absolutely mental. $750 billion. And what it was a repeat of something that had already happened, which happened in 1998, which was the collapse of long-term capital management, which it's a cyclical thing. And if you study the history of finance and business, speculative investment and everything, you'll see that this is sort of the same story. It just keeps happening over and over again. And 9 times out of 10, the solution is to bail everybody out. And that's what they do. You make a poison pill, shit sandwich, whatever you want to call it, and everybody takes a bite. And that's how we got out of Lehman. And the Lehman crash really was a hangover from the collapse of long-term capital management. So in terms of like how to approach this and the whole history, if you have any interest in this, but I mean, seriously, if you want to understand how American society in particular works, you should research the history of the people who have financed it or caused these huge, spikes, crazy patterns of behavior, gross assumptions, gross hubris, arrogance. These are all just people, and there's nothing special about them. There really isn't. Like, I don't give a shit how advanced your knowledge of prop and stat and, fucking x-axis interest rate swaption. I mean, it's just, most of it is lingo. Most of it is lexicon. They come up with new ways to package bullshit. And whenever there's a new sort of instrument, they love to call them, it's really just a new bet that's so convoluted that not everyone understands it. So you can briefly run the table in the markets because you have a bet on that no one else has figured out how to even make. And there are some really, there are just, you can take it all the way back to the beginning of money. So my collegiate education was really about the emergence of debt as a social contract across Europe. Because obviously there was a very different sort of attitude toward debt and usury in the sophisticated Middle East countries and stuff. Once Christianity kind of got locked into Europe, you had the whole problem with tension between Christians and Jews, anti-Semitism, etc. Edward the Longshanks in England, he started the whole, like Hitler, everything he did was actually based on what Edward the Longshanks had done to European and Italian Jews who had lent money to the crown in England, like literally had them wearing yellow stars and stuff. It's 100% his playbook. So in the tradition of like cyclical historic behaviors and peaks and valleys was sort of what I focused on. And one of the loud indicators in that is moments of outsized debt accrual and then really irresponsible, basically just creating a way to excuse yourself from having to pay the debts, whether it's going to war, convincing the people that you owe money to are now all of a sudden bad, or, eroding your society in some way. These tricks of these cycles, they're all old. They've been around for a long time. And so there's two things that if you want to sort of understand what I'm saying there, why this is cyclical and why it's the same thing, there's two incidents in the history of Wall Street that are extremely instructive in understanding the evolution of American free market capitalism. So basically, the 70s was a shit show for everybody. England, horrible, depression that they didn't even get out of until like 83. They didn't even come close to turning the corner. Famously, people now are touting how high the unemployment rolls in America were in 1982. There was a single week where 682,000 people filed for unemployment benefits. Now we've got 3-point-something million. I mean, the historic collapse of what we're dealing with right now is just not for me to write, but it will be written about forever, unfortunately. But if you want to compartmentalize it, like what happens during booms and why do we keep having booms and busts? We didn't have a ton of that during the sort of 20th century because you had 2 world wars and all the debt and international, obligations that come out of that. Germany's told they have to pay like a quadrillion Reichsmarks, and it's just a joke, and everything just comes back and becomes another war again. And so, the whole point of the market that we have and the patterns that the markets followed, you don't really have that until the 80s. And that's something that, is not really understood. Like the paper crunch in the 60s, the go-go funds, Tiger, all that stuff, that's just, it's a period of stability. You don't have excess. You have lend at 3, borrow at 3, lend at 6 on the golf course by 3. That's the old joke. You'd borrow from the Fed at 3%, you'd lend to consumers at 6%, and then you'd be out of there by 3 o'clock and playing golf. That was the joke about how easy everything was for banks that were capitalized. And you just had this really bad trough in the 70s. And, market makers that survived the paper crunch in the 70s, then you get into the mergers and acquisitions hysteria of the 80s. How's that happening? And this is the first example. There's a firm run by a guy called Mike Milken, who's incredibly famous. They were called Drexel Burnham. There's 2 really good books about this. This one is totally sensationalistic and kind of tabloid trashy. It's a very 80s tone book. This is pretty crazy. They tried to buy every copy of this to destroy it. That move, like Drexel Burnham, Mike Milken tried to buy every copy of Predator's Ball and destroy Burnham. It's absolutely nuts. Like, this is really well written. It has a lot of good sources and quotes and stuff. This is, like I said, this is like a wannabe Dominic Dunn type book. You can kind of tell that from the cover, but it's true in the page. Like, this book feels like it looks. Really melodramatic staging. But what Mike Milken did is he worked harder than anybody else. Like, this guy got tarred and feathered. They tried to run RICO acts against him. Giuliani made his name sending this guy to prison. And then, of course, he came down with cancer in prison, and there was some sort of, leniency. I don't know if he was pardoned. I never really, because by that time, he's doing whatever he's doing to try to make peace with his life and become like a good citizen, let's say. But there are plenty of people who came up in the 80s who were around when Mike Milken made his bones. And half the people are like, yeah, he absolutely crossed the line. He should have gone to jail. The other half are like, he didn't do anything wrong at all. Guy was totally playing the hands that the Fed and everyone else dealt all of us, and he was playing it better than anybody. Because what he figured out is, so first of all, the main thing is data. Mike Milken is one of those people who figured out early that you have to work off of data. So he would read the actual prospectus and the 13Fs and all these documents that companies that are traded on the stock exchange are required to file. And so he understood and kept track of, the sort of price and earnings ratios, all these other things. He was developing, ways of seeing asymmetry in the market. And this is anytime there's a boom in any market, it's because there's a arbitrage opportunity or an asymmetry. And, this goes to like, we'll get into Enron or something like that. But Milken figured out ways to take. So what he did wrong was, there's a couple things he did wrong. The primary thing legally that he did wrong, and it was never proven, factually, but it was pretty widely known that there was a wink thing going on, which is that he was parking the debt from issuances he would float with other participants in his circle of, so basically just subscribers, people who would subscribe to his debt. Because if I buy 80 million of bullshit that Milken's floating out of Drexel for some, crappy, they call them junk bonds, company, now he owes me, and he makes this market. So he's the junk bond king. He's got all of this stuff lined up. So he's got the capitalization to make these things happen. Even if whether or not they're good for the economy or these companies are dog shit, it doesn't matter because the juice is there. And so what happens is there's so much activity and market making and commission and, points and all these things, all the ancillary money. This is why they always say the only people who get rich is, the investors and the lawyers. He, in a way that he thought was protecting himself, like it was just, the noise, the temperature, the body heat of what he was doing was extremely obvious to everyone on the market. And whether or not they had him on tape being like, you know, you owe me this, you owe me that, everybody wanted to just crush him, because the second mistake he made is that he was arrogant. And when you're arrogant, there's a quote in here. It's one of the most important quotes I've ever read regarding business or anything else you do in your life. If you're doing better than everyone else and you're an asshole about it, that embarrasses people, and they never forget that. The one thing you can never do in your career when you're hitting it or your things are going great is embarrass someone else who isn't having as good a time or who's behind the curve. Drexel embarrassed Wall Street. They were completely arrogant. They did insane Wolf of Wall Street bullshit. A lot of that is based on stories that are in here. There is, all that bullshit you ever see in movies like Boiler Room and stuff like that. A lot of that this was when that got really crazy. And American Psycho, to an extent, is also a movie that's hugely representative. But like, all the jokes in that movie are so fucking brilliant, and I don't know how Bret Easton Ellis researched that book, or if it was family or relatives, whatever. But some of the key notes of that mid-'80s period, which is what this is all about, it's like everybody was a vice president, everybody had a secretary, everybody was somebody's son, and there was just so much money available going into the market because Reagan's trickle-down bullshit, laissez-faire economics, was really just opening the floodgates for a number of activities that were not being regulated yet. And the main one was programmatic trading. So program trading and insurance on program trading, which, if you know anything about the recent financial history of this country, as soon as you hear that word insurance, that should ring a bell, because AIG is what really fundamentally blew up when Lehman shit the bed and everything else crashed in 2008. AIG was selling insurance on positions that were basically acting as a backstop for them to go lever up like 9-1 on these trades, because it doesn't matter. AIG bought it. They're so dumb. AIG was so stupid that they would insure things without looking at what they actually, factorially amounted to, because that leverage goes in both directions. So if you've got levered positions on, that's going to blow you the fuck out when the market goes south. And then you have the problem of unwinding these trades. And so when the music stops, that's all unwinding means. The music stops, everybody's got to find a chair. Well, you've been betting that there's 150,000 chairs and there's 10. So, when that comes whipsawing in the other direction, that's when you have massive blowouts where it's like the entire system is not going to work tomorrow. Like the credit market's frozen, or the repo market's frozen, or, all these aspects all these companies that make this stupid machine work, which only, is of any use to the people who are participating in it, they all blow up. So Drexel got taken out, essentially. There was no smoking gun there. There was no there in the way that there needed to be for Rudy Giuliani to pursue a RICO charge against Mike Milken. It's just that everybody was so butthurt by how he completely transformed and monopolized access to the credit markets that they got pissed. Because remember, like, the other thing too is you got to remember there's like Solomon Brothers, Kogan, Berlin-Well, CBWL, like the history. It was a very stuffy reputational business finance that was, your word is good enough for me, Sandy Weil. Let's have Travelers, Amex, and 5 other companies merge and eventually become Citigroup, when it was absolutely illegal under Glass-Steagall for Citigroup to exist on Clinton's watch. But they let them fucking do it. They literally let the law that existed in this country be broken. Bill Clinton let this happen with the assumption that, we're going to repeal Glass-Steagall anyway, which didn't happen for almost 18 months after Citigroup functionally existed. That's another crazy story to research. I mean, you can just Wikipedia that. It's pretty clear cut. But so, Drexel blows up, and I talked about program trading and insurance. That's what caused Black Monday in '87. Programmatic computer trading and the insurance contracts against that were basically inflating the entire ramp up before Black Monday in 87. And what happened was you didn't have circuit breakers. You didn't have any understanding of how much leverage was baked into these positions that was going to, like I said, whipsaw down when people started selling to cover their exposures. When you have margin calls at this level, you can't make them. So if you want to understand Black Monday, kind of the whole history of all these firms and things, this is one of the most important books ever published because of when it was published. This was published in September of 2005, right before all this happened. The last page on this would be like reading a book that ended on September 10th, 2001. It's just the tone, the freedom with which some circumstances are talked about in this book would not have been talked about after the 2008 crash by anybody as openly as they are in here, particularly with respect to the collapse and the reconstitution of the entire fucking American financial system with the failure of long-term capital management. This book is not great. Some of the writing is, I think, a little bit tawdry, but between the summary of the long-term capital management collapse in this book, What Goes Up, which is a pure oral history, and it goes back to like the 50s. It's astonishingly important. And this book, which is much more detailed, that stuffy, Solomon Smith Barney sort of era peels away and is essentially the grave, like you put a fork in it with Black Monday in 87. And that's when, like Peter Lynch, who started the Magellan Fund for Fidelity, he comes out and he's just like, well, if I make it out of this, I'm just going to retire. I mean, the guy was a legend, but he had like fucking dozens of lawsuits trailing him when he left, actually. Nobody knows about that. But yeah, long-term capital management is an astounding story because you had a guy, John Meriwether, who'd been rushed out, basically kicked out of Salomon Brothers, like one of the top line tombstone firms, like Goldman, Salomon, all these. This is like the big dog shit. I mean, Goldman wasn't even Goldman really until Corzine comes in, into the 90s. They were not doing that killer at various points in the 80s. It was still the old firms that ran shit. And when I say tombstone, that means, like when you think of mergers and acquisitions, and if you've read Bonfire of the Vanities or you understand the whole RJR Nabisco merger, that was like the absurdity of how bad 80s versions of valuating companies was. So in the 80s, you were valued on your assets under management, right? So if your CEO pay package is determined on how big your company is, so you got to make your company bigger. So what do? You go and you buy like 50 other companies and you make your assets under management bigger. For your company, not as a financial management, that's a different thing. Assets under management for a financial services firm is a different thing. Your capital assets as a company get bigger, you get paid more as a CEO. That's how they did it from the 60s to the 80s. That's why you had the peak of absurdity with a tobacco company buying a fucking food company with RJR Nabisco in the late 80s. And the tombstone is the record of this deal, the sort of broadsheet terms of the deal on the front page. And you got to get your firm up there. And so everybody, that's what they always competed for. And that's where Drexel, like the idea of Drexel being on a tombstone for a major merger was anathema to any of these guys. I mean, you take like KKR, these big firms that were movers and shakers in the late 80s, Kidder Peabody and shit like that. The idea of Drexel, like this scum West Coast, like Mike Milken moved Drexel to California. He was the original like Elon Musk figure. Like he built these custom trading desks that were X's so that 4 people would be facing each other and you'd have more efficiency that way. I mean, he did mental shit. The biggest mistake Mike Milken made was he let his brother have a de facto job with the company. And his brother was just rubber stamping everything. He had no idea what he was doing. So that's how Giuliani got him by the nuts. He said, if you don't do a deal, we're going to put your brother in jail for the rest of his life. Can you believe that? That's how Giuliani made his name. He threatened to send a guy's brother to jail because Milken was weak with his family member and basically had left him open to actual prosecution. So yeah, Giuliani's a fucking swell guy. But what LTCM was, you had this guy who very contentiously got kicked out of Salomon. So then, sorry, I got to interrupt. This is really the key book that leads up to this, which is Liar's Poker. So Michael Lewis is probably the most famous financial author ever. He wrote The Big Short, Moneyball, all that stuff. these got turned into massive Brad Pitt vehicle stuff. They're fucking awesome movies. They're great. I don't think Steve Carell is really a great casting call on that for Big Short. But so this is his entire experience as a kid in the 80s working for Salomon Brothers, which was like one of the biggest fucking jobs you could ever hope to get. It talks about how he got this job by going out to dinner and impressing some woman who was the wife of some guy. And he's like, come on. Like, I mean, it's so funny. He tells a great story too about like this chosen one from England, this British, trader in training or whatever. And he literally just be passed out in the middle of the floor, hungover every day. He wouldn't even get up till like 2. Nobody gave a shit. The stuff in this book is amazing. Anyway, Liar's Poker is what you like. You make the smallest bet possible so that the terms of the bet have no way of influencing the outcome. And it becomes 100% about your personality and your gut. It's a gut check move, Liar's Poker. And so this book is phenomenal in that it talks about that sort of weird window before the 87 crash and like the crazy heights of 85, 86. It talks about the guy who ran their mortgage desk, Lou, I think Gluckman, I forget. There's a whole bunch of key players that come out of this, and one of them is John Meriwether. So Meriwether basically goes like this and gets bumped out, and his revenge is he's going to form long-term capital management. So he does things with long-term capital management that are unheard of. He says that I think it's like you have to have 25 million to even be an investor in it. You're captive for 3 years or something, meaning you can't take it out. I mean, shit, nobody would ever sign on for, even if it was, it's John Meriwether. He's big shit. Everybody knows who he. No, what he did is he got fucking Nobel Economics Prize winners, Burton and Scholes, to join his firm. So you have 2 guys who wrote the most fundamentally important financial, mathematical equation ever on the board of your fund. So now all of a sudden it's like, well, you can kind of ask for whatever you want. And what they were doing was they were creating a synthetic vehicle, much like all the synthetic vehicles that have been created in the past, that were correlated trades of interest rates. So you have like the relationship between currencies is a key thing. And the relationship between the peso and the dollar is historically known to be X, right? Any variance in that is short term and is going to regress to the mean. All of their trades were based around historic data and pegging that to a mean and an assumption that all things aside, momentary distractions will revert to the mean. So you can very comfortably and very levered bet against them staying divergent. You can bet against the delta coming back to you. So you basically say there's delta out there, which is activity at a distant rate from the norm that should be expected, and you make that bet. Now, they were doing this with like 16 different currencies in the matrix just to get more leverage. And the joke in this, they called it, it's not just in this book, it's been said famously, that what long-term capital management did was pick up pennies in front of a steamroller. And that's exactly what they did. And their returns, because they were the only ones, that they were fucking geniuses. Let's not confuse the issue. They were the only ones who could see this as a trade to put this on, to make this book, meaning, book of business positions. And so their order book, their whole deal was unknown to anyone. No one had come up with this idea. Like, I'm going to have a trade on betting that the Nigerian currency of the moment or whatever will revert to mean while the Swiss one goes 2 ticks up on this. And you'd have like 5, 10, 15 currencies involved in individual positions. So because it took everyone so long to figure out what the fuck they were doing, they ran for like 2 or 3 years generating ridiculous returns. Ridiculous, but not like 300%. I think they were up like 30, 40%, year over year, which is astonishing back then. You don't get those returns. It was impossible. So they were the darlings of the street until everyone started figuring out what they were doing, because computer trading and vision into the market got stronger and stronger. So more and more firms were able to kind of figure out, it's like, think about a black hole, right? There's heat coming from a black hole. And eventually you can sort of map the heat to figure out, well, there's the black hole. It looks like that. That's what these other traders did, particularly young traders at Goldman Sachs. They figured out how to reverse engineer all of their positions, and they took the other side of those trades, which meant now there's action on these bets. And if these bets go down, they're fucked. And what happened was two things happened that had never happened before. One, in 1998, Russia, I think it was 98 or 97, two things happened. There was a currency crisis in Thailand and across basically Southeast Asia generally. And then Russia defaulted on their currency obligations. They basically were like, fuck you, we're not paying you. It was totally unheard of. It destroyed, whether or not LTCM, it's almost like fortuitous that they set themselves up to absorb all of the economic impact of that happening. They had bets on that assumed a normality that could not possibly be interrupted in the way that it was when Russia defaulted. The Russian default meant that they lost $2.5 billion in a month, which at that time was the greatest trading loss ever recorded by a firm. And they were bleeding out of every orifice. So while they're trying to figure out a way to bail themselves out, everyone on Wall Street who potentially would have helped them fucking hates them because they've been such obnoxious assholes. They had given Bear Stearns a hard time. They were, constantly looking for more free money from everybody, Merrill, Goldman. Why can't we just, you guys should be giving us whatever we want. We're making 30%, fuck you. The second you're not making 30%, fuck you. And that's what happened. So what they did is they basically started getting the phone calls, Washington's getting the phone calls. The entire world, the entire American financial market will not open on Monday. The world stops. Credit market's frozen. No one trusts anybody. It's a total standoff. Everybody is just pointing guns at each other. That's how bad it was. And they got everybody in Wall Street together and they said, listen, here's the fucking deal. You took on their trades. You were counterparties to their investments. Don't fucking tell me that you're not going to help us get out of this mess and that everyone else in America is going to have to eat shit because a bunch of Wall Street assholes were, playing fucking games with each other. And so what they did is they got everybody together and they figured out what the cost of this whole thing was going to be to the economy. And every big headline firm came together and said, okay, you're going to pay $250 million, you're going to pay $750 million, whatever it is. I mean, there's a roster in here of who had to, pay all this and how it was divvied up. I didn't reread this to prep for this, but somebody had asked me about, how do you know about finance and stuff? And I just wanted to recommend these books because this is stuff more people should know. You should understand how the country you're living in, if you're in America, wherever you are in the world, you should understand what people have gotten away with historically and how fucking dumb it is, how embarrassingly obvious everything is and how repetitive these cycles are. And they just wrap it in self-fulfilling math equations and bullshit. And they got this whole thing together. And this is where this is why I'm trying to thumb through and see if I can find that where they talk about who paid what. Because what happened is right when this came down to the end, to the wire, I believe it was Bear Stearns. It was either Bear Stearns or Lehman. I think it may have been Lehman. Somebody was basically saying, fuck these guys until the very end. And what happened in 2008, just 10 years later, was that they got fucking destroyed for having been too big of an asshole and too self-righteous during the bailout of LTCM. Lehman was destroyed. It was total revenge for this incident. And it's also why Bear was put into a shotgun marriage at $2 a share, Bear Stearns, because those were the two who weren't going along with everything that the government, big time federal, litigators, whatever, attorney generals involved at this point. The deal that was brokered to save this game, it's a fucking game, and let everybody keep playing the game. Lehman and Bear thought that they had been done dirty and they weren't going to, they just had too much pride. They were too prideful up to the end, and it killed both those firms in the Lehman collapse in 2008, the mortgage crisis, what they called it. It had nothing to fucking do with mortgages. It had to do with financial instruments, securitized debt obligations, CDOs. These are so commonplace. If you've watched The Big Short, you have essentially a fundamental understanding of what was going on and how crazy it had gotten. And they were gassing regular people. This is the whole ninja loan thing. Anyone, free credit, ghost credit, fuck it. You know what I mean? It was that bad. And that was that joke when he goes and interviews those bros down in Florida or whatever in The Big Short, and they're talking about how their pole dancer is, doing real estate. I remember that time. Everybody was flipping houses. Why? Because the market was inviting and tying these loans and reselling them so that they just got off their plate. Invisible. It was all invisible to everybody. The second you securitized that and created tranches, the idea that anyone with the sophisticated education in finance would not at any time have stopped and looked at the whole securitization model and said, this is the dumbest fucking thing I've ever seen. Who would participate in a fucking investment vehicle that clearly states right in it, here's your tranche A, double A, triple A, BBB, like you're re-rating shit, but based on its constituted notional value. You can't re-rate a mortgage. The mortgage either sucks or it doesn't. And the stack ranking kind of way they did this, the fact that anyone would have participated in this market is just fucking ridiculous. But nobody was minding the store at all. GWB didn't give a shit. They had no economic policy during his 2 terms at all. And then, Obama had to come in and clean it up. And, I can't say that he necessarily did much about it. Nobody could. It was the street's problem. It created its own problem. It needed to save itself. But, if you kind of look at it this way, if you wanted to just invest a little time, you start with Liar's Poker, then you read, What Goes Up, that oral history, and then When Genius Failed on LTCM. This takes you pretty much through what's the beginning of our current economic disaster, is the 80s into the 90s into 2008. This gets you right up to it. And as I said, those 2 books, the whole stuff about Drexel Burnham is I find fascinating, because you have outsized characters and you have really crazy stories, and you have somebody who was, you can be on either side of whether or not Milken was, a bad actor or somebody who was just really good and had a different ethical, moral compass. And, he was a young Turk, man. I mean, he came up and he basically just said, all you guys think you're so fucking smart, yada, 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 I'm going to blow you out of the water. There's a long tail revenge that happens every time someone does that. Yeah, I mean, the Obama bailouts were all hilarious panics. The United States, that is 100%, it's the second time I'm saying anathema, but the United States should never be bailed. We're supposed to be free market. Like this whole thing, go to Ken Lay, the fucking asshole who started Enron. Ken Lay was a nat gas guy down in Texas, didn't know his ass from his fucking elbow. He's pressuring Reagan to, open up the market. We got to let the market wants to be free, man. And, Reagan's like fucking half dead, Alzheimer's. And they let this whole thing get so out of control with companies deciding they were self-auditing. It's S&P, Moody's, Fitch, it's Anderson, like Arthur Anderson, it's all the auditing firms. If you watch The Smartest Guys in the Room, that documentary, I worked with Bethany McLean at Fortune when I worked at Time Inc. We didn't really have any personal interaction. A friend of mine worked directly with her, but I never would have. I was a fucking IT guy. But she was like a kid when she started writing this, and she got the word from somebody that was like, you need to look into this shit. This is fucking dark and bad. And MCI WorldCom was the same scenario. That, the way we talked about M&A and building up the size of your, assets of your corporation, your conglomerate, that's how CEOs got paid in the 70s and 80s, really the 80s. By the time of Enron, you're getting paid based on your stock price. And your compensation package, because it's a sort of novel thing, is now shifting almost 100% to stock. And so Sam Hyde and Dive are probably classmates. The guy from Dive. Dev? I don't know. Anyway. CEOs are getting paid based on stock share. So there's jokes on The Smartest Guys in the Room that like the Enron stock price is in the fucking elevator. Like at a time when they didn't have screens and elevators, but Enron did. And that movie, that article, the book, everything, whatever, everything Bethany McLean did, I really have a lot of respect for her voice, and how she's never been tawdry. Like if you did something shitty, she's going to chew on that bone a little bit, and you deserve to have that bone chewed on if you were a piece of shit. But she doesn't do like wild haymaker melodrama. She does have a little bit of a moral righteousness to her, but I think she's earned it. She's the one who blew this open. There were other people that had been screaming to be listened to that Enron is a total fucking black box. This shit isn't right. They're self-declaring, like the main thing that killed Enron is that they got mark-to-market accounting. Mark-to-market accounting should not exist. This is an insane thing. SOX audits are still internal. Yeah, SOX 1 and 2 are still internal. But the thing is, I mean, you still fail them, even though like you can't like make them up. Like you can have internal SOC 2s and you'll fail them. Like even if you're doing it yourself, that thing is set up to sort of let you know what your problems are. I've done tons of like SOC shit, and you name it. I've been around all kinds of compliance shit, NIST, PCI, HIPAA, whatever, GXP. But what I was saying about Enron is when they got mark-to-market accounting, that's it. Because mark-to-market accounting is totally insane. It should not exist. And if it were to exist, the only function it would have would be to allow a company to more immediately reflect a positive cash flow in the market, meaning get people to invest in them. Which, again, what it means is like you do a deal and then you can basically say that those profits exist on your bottom line. So like Enron started doing fake deals to inflate their bottom line or cover up losses in other parts of the company. So the big one that blew them out and totally fucking destroyed the company is they got stupid, and they were so fucked and so desperate for money to recapitalize that they parked 2 Nigerian oil barges, I think with Merrill Lynch, and Arthur Andersen signed off on this. Nigerian oil barges this is insane. They're literally sitting off there to try and like give oil service to a company that doesn't have infrastructure. They don't make money is the point. Like this is just a deal to move assets into another place. And then they were making up shit. They made up internal companies, chargebacks, losses get hidden inside, the whole bullshit of, and you see the charts and how Chuko and all this bullshit interacts. It was just absolute basic 1929 Great Crash criminality, the same way Shenandoah and all of the big stock issuance crises that got the Main Street and the common man and woman wrapped up in the 20s, the Roaring 20s. It's the same exact thing. And I didn't bring down the actual book, The Great Crash, but the other person you really got to read is John Kenneth Galbraith. So he was Kennedy's economic advisor. He did World War II economic planning as one of his first jobs. He wrote the definitive book. It's called The Great Crash on 29. And between these 3 books, The Affluent Society, Money, Where It Came From, Whence It Came, Where It Went, and The Great Crash, these 3 Galbraith books are absolute cornerstone. The Affluent Society, basically, so John Kenneth Galbraith coined the term conventional wisdom. He basically treats the behavior of people as an observable fact. Like people do these things all the time. And he's just, the savagery of his fucking quotes is just beautiful. I mean, there's so many things. My favorite quote of his is, economics exists in order to make astrology look respectable. But so this is sort of a broad introduction to the concept of money, debt, notional stuff. It's great. The Affluent Society is really, it's an acceptance of, okay, this is America. We're moving into a consumer society. We are moving into a service economy, essentially. What does that mean? People have been striving for leisure time their whole lives. It's one of his fundamental things he calls out. And that's something a lot of people don't realize, is that you can boil down a lot of the pursuit of human liberty to really more leisure time. If you live in horrific circumstances, subsistence circumstances, going back to Middle Ages, medieval times, all that stuff, what you're striving for is a little bit more leisure time, just a little bit more time, easier life, something. And, if you come to the peak of that and all you have is leisure time, how do you have an economy? There's a lot of interesting questions he gets to, and he's never preachy. He's a little stuffy. I mean, by nature, he's a Harvard guy. He's got like 15, 20 books out there. I'd say, Money, Affluent Society, and Great Crash. That's your crash course on Galbraith. And he speaks to everything, really expert. He's one of the most brilliant economists ever. And yeah, that whole thing of these cycles of the same thing, it really goes back to the Lupins. I mean, this is the biggest joke in the world. But this book, and particularly this edition, Extraordinary Popular Delusions and the Madness of Crowds, is it's an academic textbook. Charles Mackay wrote it a long time ago, and it's been updated a million times. But this is somebody who is actually in a position to write about the tulip mania in the Netherlands, and he goes through from like the 1300s to the 1400s, and he actually has details on the specie payments and like credit lines that were being issued for people to buy special tulips. And it gets into the South Sea Company and the concept of floating debt to public subscription based on, the prospectus of the firm. And there's a really famous thing that happened around the time of the South Sea Company where someone formed a business, and it's the most insane thing ever. What is it? Oh my God, it's so funny. But he has a list here of companies that were formed during the South Sea bubble in England in the 1700s, I think it was. And these are the prospectuses of these companies. It's like for erecting salt works in Holy Island, for trading in hair. That's it. Like that's all that was on the document. For supplying the London markets with cattle, for importing beaver fur, and so there was one company that's so famous, I can't find it. I wish I could have just pulled it up. But there was a company that was formed that said, for the investment in a great adventure. That was literally all the prospectus said. 2 million, whatever, being raised pounds for investment in a great adventure, like to be named later. It got that crazy. And it's all a game of telephone. You hear about somebody down the street invested much money, double his money, greater fool. As long as there's a greater fool, somebody's going to make money. Greater fool is going to lose it. And that's all these things are. It's a game of telephone between people who, don't know, want to be rich, want to keep up with the Johnsons, conspicuous consumption, go down to Guy Debord, Society of the Spectacle, right? The whole notion of accruing wealth and the social distancing that comes with wealth. I know there's a lot of hysterical, zero hedge types re-promoting this notion that this is a disease of the rich and blah, blah, look, if anything if anything inspires countries like Brazil, places that are just totally economically isolated from participating in any of this, if anything, makes these people sort of demand accounting of how bad the division of wealth in this world is, fine. If Corona helps people talk about that more openly and compels, the 0.01% to figure out ways to do something different and invest in a balance, less asymmetry in human wealth and standard of living, that would be great. It doesn't necessarily mean socialism. There's a lot of ways you can do it in capitalistic ways. Guys like Bill Gates have been trying to do that, but it's just too airy-fairy. And they get caught up in these, crises of morality where they want to invest their money in things they determine to be morally necessary. Well, they're living in a fucking universe of potential that's invisible and irrelevant to, impoverished people. But anyway, yeah, Extraordinary Popular Delusions is very readable. It's not brutal. This is fucking brutal. If you're not seriously hardcore into economics, don't try to read this. The Great Wave actually charts prices like real wages going back to like 1400. It is one of the thickest, heaviest, things you could ever, like the crisis of 17th century grain prices. You got price points going back to 1450. If you're somebody who's interested in the evolution of debt and wages and the evolution of, increasing, Adam Smith type stuff, Malthusian concerns about, where we get to a kind of homeostasis as a planet with resources. This book is absolutely fucking awesome, but even if you're into that shit, it is a hard slog getting through that. But it's great. I mentioned, actually, I should just point this out now. When when I was talking about the Lehman crash, I forgot to pull this out, but if you didn't get this got turned into a book. It was basically a series of interviews on the N+1 snooty literary site. Someone knew somebody at some firm and got him to talk to him. And it's basically whoever the person that is being interviewed that's, a fund manager or whatever is, they're pretty young. It's pretty clear they're young because they're being very cautious and careful in the things they're saying because they know they don't know shit. And they know they're just like, this is the thing. When you get to be a portfolio manager, the order of the day is conservative thinking, not being emotional, being considered, not speaking, based on hypotheses or theories or personal emotion. I can't talk to them like it's just the effort to seem in control. You can just see like their skin moving under, like it's pretty brutal. I don't mean to be obnoxious about it, but you can, if you've ever been around people in those type of jobs, it's such a common thing, the tone and the way this guy talks. And whatever. Another great general one. This is also very deep, but very readable, and has some really cool stories. It also has a big chapter on arbitrage and long-term capital management, and I just didn't pull it out at the time, but it's called, I love the title. It's one of my favorite titles of like a book ever. An Engine, Not a Camera. This is a really incredibly strong history of how statistical models have caused destructive explosions, like the relative value arbitrage and the convergence trades, like I mentioned, of regression to the mean, those converging, they do the Greeks, delta, gamma, beta, all that shit. Like this is also very readable. I forgot actually, but this does have a lot of LTCM in it, more than I remembered. I think the central thrust of this is because it's the biggest example of how the illusion of a model will engender conviction in really incredibly stupid, risky moves. Reputation, that's an old logical fallacy. I forget what it's called. Deference to the throne, maybe, or whatever. Basically, no, deference to authority. Yes, deference to authority. So basically, somebody who's won an economic prize, you're going to assume that they know what they're doing. Don't. That's a lesson of this. And the other is, don't get fooled by math. Somebody just posted "fooled by randomness." I'm not a fan. That's the only book of his I've read that. Like, I lost respect for that guy when he said some bullshit like, "Do you think Plato was taking statins?" It's like, no, but he was dying at 32. Like, what the fuck are you talking about? He's just, his whole like guerrilla mindset bullshit, that whole pivot after Lehman blew up. I lost a lot of respect for. I just, but fooled by randomness is good, I guess. It's so fucking condescending. He's such a condescending prick. Even before he was anything, he was condescending to everybody. And that's just a horrible trait. If you're somebody who's successful in life and has, through whatever means achieved a position of financial independence and wealth, don't be an asshole. He's so addicted like crack to being right and showing other people how wrong they are, both at the same time. And I think a lot of his assumptions in Fooled by Randomness are complete horseshit, actually. I had to throw the actually in there. All right, I'm just going to do a couple more minutes on this, and then maybe I'll come back later tonight and do music shit, because this is extremely niche. But this is hilarious, and you should find it. It's been in print forever. Adam Smith's The Money Game. This is a cute little funny fake book that tells you stories about the evolution of companies like IBM and like old investment and stuff. And again, it's one of those books that reinforces all those traits, all those common things that happen over and over and over again. It's really fun. It's just like a bathroom read. It's totally a poop shelf book. But there's so many good fucking stories in here, about, the madness, again, the madness of crowds. Like this is about the madness of crowds that leads to things like the Roaring '20s and the '50s and Mr. and Mrs. Main Street dabbling in the stock market. A lot of the jokes in Glengarry Glen Ross are actually from this book. It's do I have a Goodreads? No, again, it's like Last FM. I don't catalog my interests online. I'm not interested in turning myself into a cookie. You'd be surprised how not niche it is in this moment. People want the black pill on money as a game. People love it. Yeah, it's really it's laughable. If you do the history, you're not intimidated by any of these people or their fucking bullshit watches or cars. They just look like, you know, every other jackass that's ever managed to get themselves mainlined into this fucking joke. And that's fine. But yeah, I just like to be able to expose them. I mean, if you go, if you're not working on the business side of a firm, right, and you're some, you know, IT guy, and then you start talking to them about long-term cap and John Corzine and, you know, hey, remember when this happened and so got blown out of the market? Most of them don't know this shit. That's why these panics keep happening, because of 27-year-old traders who don't know their ass from their elbow, and portfolio managers who, as long as the returns are coming in, they don't give a shit either. Nobody is paying attention to the fundamentals. Yet, whenever there's a problem in the economy, they can't wait to tell you the fundamentals are sound. You go back and look at every economic crisis that's ever happened in this country, and the same quote has been trucked out. The fundamentals of the American economy are sound. They're not. They're variably conservative or variably, you know, over-levered. And that's all it is. It's totally just a ride. It's just a fucking carnival ride. The whole thing is a casino. Anyone who pretends it isn't is just, you know, drinking their own Kool-Aid, and it happens every time. Doesn't mean that you know anything. I mean, again, you can keep saying no every day and you're going to be right most of the time, right? I mean, being aware of it doesn't lend you any special credence, but it helps you sort of understand it. Whether or not you get to participate in it, you know, I don't have that kind of money. I'm never gonna. I've never trusted the market. I've never been heavily in the market. I've never been a big trader. I mean, mostly because while working for these companies, I'm not allowed to trade. That's only something I've recently been able to do if I wanted to. But, you know, when you look at how the blue chips get killed, basically the blue chips become sort of like an inversion of gold or specie. The blue chips are like, the American economy is not good, sell them all, you know, but give Elon Musk, you know, $4 billion in unsecured bullshit for him to go dick around and party with Grimes and drive a fucking fake steel-sided fucking trapezoid up on stage. Like, that's a good way to use your money. Anyway, and then this is another interesting one. There's a couple of these, actually. This is just the last point I'd make, which is just kind of general reasoning. I've talked about a book called About Thinking, which was a really important book I read on logic and rhetoric in college. I didn't bring it down here, but there's a guy called William Poundstone who's more famously known for writing this book series for kids called Big Secrets, that exposes things like how the Rorschach test works, what it means, and you know, like, is there cocaine in Coca-Cola? Or, you know, all these, the Anarchist Cookbook, what is it? You know, and can you make a pipe bomb out of old aviator cards because they have glycerin in them? I loved his stuff when I was a kid, but I found out later that he's actually like a logician. And he's written two really strong books, Labyrinths of Reason and Prisoner's Dilemma, about von Neumann. And basically he deals in, you know, cooperation, the logic of cooperation, and how much and how little you can work emotion out of game theory. So this has obviously broad political and economic impact, but, you know, if you couple those two books, which part of these are actually pretty deep and rich, considering the guy's written kind of fun commercial, you know, trade paperbacks on like things that mystify kids or whatever. There's another guy, Robert Axelrod, who wrote a pretty signature work called The Evolution of Cooperation. And so, yeah, but, you know, this kind of triptych of readable, this is less readable. There's points in the end of this where it's like, I don't want to read this anymore. It hurts my brain. I mean, if you get into like these kind of things, which are essentially like pattern evolution based on pathing and those kind of things, I'm not great with mathematics. I'm not great with code. I never have been. I'm very much a literary reader, philosophical reader. This stuff just takes it way on. I mean, seriously. I mean, he's printing out the tables of outcomes for things, but you don't have to get into all that to understand, broadly what he's talking about. It's funny because if you're like a deeply philosophical person and you've studied philosophy, you get into Hegel and you get into a lot of bedrock philosophers who've informed kind of the evolution of these choice-based theories. Like, if we have free will, what does that mean? What predictions or what assumptions can we reasonably make? And if we can't, how can we cooperate? And that's sort of what these are about. Minimax and all these other theories historically, they're really about figuring out like how much can we know about an engagement with another person. And these are just baseline fundamental questions of cooperations. The match head pipe bomb. I'm glad a lot of people are calling out that they've read Prisoner's Dilemma. Don't say game theory. I know there's someone in our Chord that has an issue with the band game theory and posts them way too often. But it's just been absorbed into the lingua franca of the Chord. So yeah, it's an hour. That's a quick little hour that'll go on there, and we'll see. Maybe I'll come back later or not. I don't know. And do I did pull the Billboard books, so I have the 80s and 90s. The Joel Whitburn, but again, anybody, like I was talking before about music supervisors, like all they do is read Joel Whitburn's chart books. It's ridiculous. All right, so yeah, well, maybe we'll talk later if I get time. I don't know. Let's get a good shot of that bad boy. It's hard to do with these stupid YouTube lights, but it's brown. It's all brown, and the dual heads are bronze. It's awesome. It's really pretty. Dipper Economics. You bet. I'll bring this one in on the next one if I do it. Peace.